Well, on the subject of interest rates, the Council of Financial Regulators, which is made up of the Reserve Bank, Treasury, Bank Regulator APRA and the Corporate Cop ASIC, today decided to maintain the mortgage serviceability buffer at 3%. So in other words, any person now taking out a mortgage at, say, 6%, they'll be assessed on their ability to repay that loan at 9% if rates keep on rising. But this does cause problems, especially for the 600,000 or so people coming off fixed rate mortgages, which effectively can lock many of them into their current lender at higher rates than they might otherwise have paid. Leith van Onselen is the chief economist at the MB Fund and is the co-founder of the Macroeconomics website and joins me now. Leith, many thanks for your time. Just explain why the Council of Financial Regulators maintaining the serviceability buffer at 3% locks people into mortgages.
Yeah, so Ross, the Reserve Bank showed that there's basically 880,000 people that are going to come off ultra cheap fixed rates of around 2% this calendar year, and they'll revert to variable rates now of around 7%. And what this basically means is that those borrowers who took these loans out over the pandemic were effectively being assessed at either 4.5% or 5% mortgage rates. And now, because they'll come off at 7% mortgage rates roughly, they're now going to be assessed at around 10% mortgage rates. And what this effectively means is loans that they qualified for during the pandemic, they no longer qualify for. And what this does is it then locks them into their existing lender and means that they can't refinance to a cheaper mortgage. Now, this is very bad for financial stability because obviously we're going to get to a lot more people who are going to be forced to sell because they can no longer afford to meet their repayments. It's obviously terrible for the individuals involved, and around half of all loans over the pandemic for first home buyers are fixed rate, and those people are under the gun. And it's also obviously bad for competition because if you're a bank and you've got a borrower who's basically a mortgage prisoner, you can basically charge them an uncompetitive rate, fatten your profits, and those people can't do anything about it. So it's really a disastrous policy. I don't have a problem with keeping a 3% mortgage buffer for a brand new, borrower who doesn't already have a mortgage. But if you've already got a mortgage and you've been through the process, and all you're doing is you're locking those people in prison, you're going to force them into, greater financial stress, and you're potentially going to cause a wave of forced sales and panic selling, which is going to then obviously destabilise financial stability in the housing market. So I think I think APRA and the Council of Financial Regulators have badly erred here.
OK, so what were their options, though? They could have reduced it to 2%, but that really wouldn't have made much difference, or they could have dropped it to 1% potentially. But again, this is about trying to make certain that your banks are unquestionably strong. That's what they're trying to do in the face of what is expected to be significant rises in unemployment, which is going to clearly put pressure on some households.
Yeah, see, what I would have done is I would have kept the 3% buffer for brand new borrowers, so for those who don't already have mortgages. But for those already in the market, they've already got their mortgage. And I think they should basically remove the mortgage buffer altogether. They've already been through the assessment. And effectively that would improve financial stability because these people wouldn't then be forced to sell, and also give them obviously more cash flow. The last thing we want to do is we don't want to see, thousands and thousands of, especially first home buyers that borrowed during the pandemic basically being forced to sell their homes. I don't think that's not good for them. It's not good for competition in the financial sector, and it's certainly not good for financial stability.
And the reality is, Leith, that many of those people who did buy during the COVID downturn effectively have got a bit of a Shanghai effect in the house price. So they've all probably built a bit of equity into those properties themselves.
Yeah, hopefully. But if you were someone who bought in sort of late 2021, you might actually be underwater because, for example, if you bought in Sydney, you bought just before the peak, prices fell by about 12%. They've rebounded a bit. So, I'm talking more, it's mostly the first home buyers. Those are sort of bought in the latter half of 2021 as prices were still rising, but they were almost about to peak. And then prices obviously fell. Those sort of people, are potentially staring down the double barrel of negative equity, as well as being stuck in these rates they can no longer pay. And they're the ones who are really going to suffer. And it sort of gets down to this whole problem we've got with monetary policy where we're trying to tame inflation by smashing the 1/3 of households that got mortgages. It's a very blunt instrument. We really need the federal government to step up with fiscal policy to help the RBA out.
I'll tell you, it's a fascinating story. We'll come back to it again. Leith van Onselen, Chief Economist at MB Fund, co-founder of Macroeconomics as well. Many thanks for your time on the program today.
Anytime, Ross.